Gold falls not because markets are calm, but because the crisis itself is fueling the very thing that undermines gold's appeal: inflation-driven monetary tightening. That's the paradox shaking markets today. A 2% drop in gold prices over Monday's opening sent shockwaves through portfolios, breaking a recent rally just as tensions between Iran and regional powers escalated. This isn't a retreat from risk, it's a recalibration. And the reason it matters now cuts straight to the heart of how investors define safety in a world where war doesn't just mean conflict, but surging oil prices and the threat of prolonged high interest rates. The sell-off hit hard and fast. COMEX gold futures for April delivery settled at $2,180 per ounce, down from $2,224 just days before. Trading volumes spiked as institutional investors rushed to unwind long positions. But here's the twist: gold usually rises during geopolitical flare-ups. It's been the textbook move for decades. So why is gold falling instead of rallying? The answer lies not in the conflict alone, but in what the conflict threatens: global energy stability, inflation expectations, and ultimately, central bank policy. Most people arrive after the move is obvious and the easy upside is gone. We focus on serious crypto education and high-quality signals before the crowd rushes in, so you can understand the setup earlier and move sooner. If you want that edge, visit the link below now. The answer lies not in the conflict alone, but in what the conflict threatens: global energy stability, inflation expectations, and ultimately, central bank policy. Iran is a major oil producer. Any disruption in the Persian Gulf could send crude prices soaring, and that's exactly what markets are pricing in. Oil prices reacted immediately, adding pressure to an inflation outlook that was already sticky. When oil rises, transportation and production costs follow. That feeds directly into consumer prices, making the Fed's job harder. And that's where the real shift happens. Higher inflation expectations mean the Federal Reserve may have to keep interest rates elevated, what traders now call a higher for longer rate scenario. That's a direct headwind for gold, because gold doesn't pay interest. Unlike US Treasuries or short-term bonds, gold is a non-yielding asset. When interest rates go up, the opportunity cost of holding gold increases. The US dollar index rose 0.6% against a basket of currencies, amplifying the downward pressure on gold, which is priced in dollars. A stronger dollar makes gold more expensive for foreign buyers, further dampening demand. The important part is not just the price drop, it's the collapse of a long-held assumption. The idea that gold always benefits from geopolitical tension is being tested like never before. In 2022, during the Russia-Ukraine war, gold initially surged, then gave back gains as the Fed launched its most aggressive rate-hiking cycle in decades. Now, history may be repeating. Analysts point to the same dynamic: conflict drives inflation, inflation drives rates, and higher rates drive investors away from gold. For both retail and institutional investors, the message is urgent. The traditional safe haven playbook, buy gold when the world burns, may need rewriting. But here's what remains uncertain: how long this conflict lasts and whether diplomacy can stabilize oil flows. If de-escalation happens quickly, inflation fears could ease and gold might rebound. But if tensions persist and crude remains volatile, the pressure on gold will continue. The next signals to watch aren't just in Tehran or Jerusalem, they're in crude oil inventory reports, Fed speeches, and Treasury yield curves. Another layer: trading volumes surged during the sell-off, confirming this wasn't retail panic but institutional positioning. Big money is shifting. That adds credibility to the move and suggests this isn't a short-term dip but a structural reevaluation. Gold's status as a crisis hedge isn't gone, but its conditions for activation have changed. Most people arrive after the move is obvious and the easy upside is gone. We focus on serious crypto education and high-quality signals before the crowd rushes in, so you can understand the setup earlier and move sooner. If you want that edge, visit the link below now. Gold falls not because the world is safe, but because the response to danger has shifted. Investors aren't fleeing to gold, they're fleeing to yield. And until oil prices stabilize and the Fed signals a path toward rate cuts, that dynamic may hold. The takeaway is this: in today's market, not all crises are equal. And gold's role depends entirely on whether the crisis fuels inflation or fear alone.